Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest episode of InvesTips from the CIO's desk. My name is Steve Brice and I'm your host for this series. Last time we looked at why investing in stocks makes sense. Today we're going to look at things to think about when investing in the stock market. Now, if you've ever followed the stock market, you'll know that it can feel like a roller coaster. Prices rise, prices fall, and headlines often make it sound as if either the world is ending or booming, and this happens every other week. The truth is simple. Markets are unpredictable, and trying to forecast every rise and fall is extremely difficult even for finance professionals. So the real question is not what will markets do next, it's how should I behave when markets feel uncertain. Let's start with one important idea. Stock markets tend to move in cycles, from optimism to excitement to anxiety and then outright fear, before recovering again. These cycles are driven by the economy, the performance of different companies and sectors, but most importantly, investor emotions. When times are good, people feel confident and prices rise. And when uncertainty appears, fear takes over and prices fall. And this can make markets feel chaotic. One of the most difficult moments for investors is during market downturns. When prices fall sharply, many people panic and sell. And ironically, this locks in losses, often just before markets recover. History shows that markets eventually move on from downturns, and what matters most is staying calm and not letting fear dictate decisions. And this is where a structured approach becomes invaluable. When it comes to evaluating shares, there's two broad approaches. So the first is technical analysis, which looks at price patterns and trading activity. And this is usually used by short-term traders. The second focuses on fundamentals, understanding what a company does, how it makes money, and how financially healthy it is. For most long-term investors, fundamentals matter more. They try to decide, 1, is this a good business that can survive tough times and grow over many years? And 2, is the market offering a fair price for these prospects? They will look at different metrics to try and figure this out, including profit or earnings growth projections, how much debt the company is carrying and whether it's generating the cash flows to service this debt, and how expensive the stock is. A key metric here is the price-earnings ratio, which is effectively the price of the share divided by how much money the company is making per share. After taking a view on these, fundamental investors will decide whether the company is worth investing in. It's important to remember that a great company may not be a great investment if its price is too high. Markets will always be emotional. Optimism drives rallies and fear drives sell-offs. Extremes on both sides actually often appear to be the norm. Long-term investing success doesn't come from predicting next move. It comes from staying patient, keeping emotions in check, and focusing on quality over time. Volatility is normal, cycles are inevitable, and a calm, disciplined approach has proven to be the most reliable path to success in equity investing. Thank you for listening today. I hope you found this podcast helpful. For more information, please click on the link in the attached description. I look forward to talking to you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.